All right, this is now chapter 5, variable costing, a tool for management. I sent you the file also. Everybody got a copy of this file?
Yes po, sir.
The self-learning objective number 1, explain how variable costing differs from absorption costing and compute the unit product cost under each method. So this slide gives us an overview of absorption and variable costing. So on the left column, we have the absorption costing income statement. It gives us the sales less the cost of goods sold is equals to gross profit or gross margin less the selling and administrative expenses. You have the net operating income. Is this not the traditional format income statement that we have? This is the traditional format income statement that we have. And this is the format that is used for external reporting. All right. On the right column, you have the variable costing income statement. What does it give us? It gives us the sales less the variable expenses. Variable expenses broken down into variable cost of goods sold. So you see here, variable product cost, and then the variable selling and administrative expenses. And as we just discussed in the previous slide, sales less variable expenses, you have what? The contribution margin. Less the fixed cost. Fixed costs broken down into the fixed manufacturing overhead and the fixed selling and administrative expenses. Then you have the net operating income. So the one on the left side, this is traditional, the one we use for external. And then this is the contribution format income statement on the right side, the one we use internally. Okay, in the middle, you have the three elements of cost, which are they? The direct materials, the direct labor, and the manufacturing overhead. But as you see here, manufacturing overhead is broken down into variable manufacturing overhead and fixed manufacturing overhead. Okay, in the absorption costing income statement, both the variable and the fixed manufacturing overhead would form part of the cost of goods sold. All right. While in the right column, the contribution format income statement, only the variable manufacturing overhead is included in the variable cost of goods sold. Now, what happens to the fixed manufacturing overhead? It is presented after the contribution margin. Okay, for selling and administrative expenses, the variable portion is presented as part of the variable selling and administrative expenses. Kasama siya dito. No, those are variable costs and expenses. And then the fixed is here. Whereas in the absorption costing income statement, selling and administrative expenses, both fixed and variable, are part of the operating expenses or selling and administrative expenses. Okay, let's have a quick check. Which method will produce the highest values for work in process and finished goods inventories? Sino daw ang mas mataas, no? Ang value ng inventory, work in process and inventory finished goods? Si absorption ba o si variable? Well, looking back here, not to this slide, ano ba yung pumapasok dito sa absorption? Si absorption kasama si direct materials, direct labor, variable, and fixed. No? Dito naman, yung fixed nawawala. And so, of course, your answer will be what? Absorption costing will produce the highest values for work in process and finished goods inventories. Harvey Company produces a single product with the following information available. The number of units produced annually, 25,000. The variable cost per unit. The direct materials, direct labor, and variable manufacturing overhead is 10. They are all combined in this number 10. And then the variable selling and administrative expenses, you have here a number which is 3. And then the fixed cost per year for the manufacturing overhead, that's 150,000. And the fixed selling and administrative expenses, that would be 100,000. Now, the unit product cost is determined as follows. For the absorption costing, as we said, all elements of costs, including variable and fixed manufacturing overhead. Okay, so 10 is given. 10 is direct materials, direct labor, and variable manufacturing overhead. So you just have to compute for the fixed portion, not the fixed manufacturing overhead. And according to this slide, you have a total of 150,000 for fixed manufacturing overhead divided by now the number of units produced, which is 25,000. Therefore, 150,000 divided by 25,000, that would be 6. Therefore, the product cost per unit under absorption costing is 16. Now let's go to variable costing. We said that in variable costing, the fixed manufacturing overhead is not included. So it's just 10 and 0 here. So the variable costing unit product cost is 10. And who has the higher number? Absorption costing. And we read under absorption costing, all production costs, variable and fixed, are included when determining the unit product cost. Whereas under variable costing, only the variable production costs are included in product. So we are making a comparison between absorption costing and variable costing. And then I'll get this. Let's assume the following additional information for Harvey Company. 20,000 units. Di ba kanina, meron tayong 25 units were produced. Is that right? Now, we have 20,000 units were sold during the year at a price of $30 each, and there is no beginning inventory. Now, let us prepare the income statement. So your sales here will be what? 20,000 times 30. Let's find out how the income statement under absorption will appear. So sales will be 20,000 times 30. That will be 600,000. Less the cost of goods sold. The beginning inventory is 0. Add the cost of goods manufactured. What is the unit product cost that we computed? In the previous slide, it was 16, right? So if you produce 25,000, 25,000 times 16, that will be 400,000. And then if you produce 25,000 and you sell 20,000, what remains in the ending inventory will be 5,000. And 5,000 multiplied by the unit product cost of 16, that will be 80,000. This is the traditional format income statement. So 400 minus 80, that will be 320,000. That is your cost of goods sold. Deduct from sales, you get your gross margin. Less the variable selling and administrative expenses. Is it given the 20,000 multiplied by 3? Let us see if it is given kanina. Ayan. You see this one, selling and administrative expenses, 3. That's the variable. And then the fixed is 100,000. Let's move forward. Okay, so 20,000 times 3, that's 60,000. Why 20,000? Because 20,000 units were sold. 3 is given. The fixed selling and administrative expense of 100,000 is also given. So 60,000 plus 100,000, you have 160,000. So 280 minus 160, you get a net operating income of 120,000. This is the one used for external reporting. This is the absorption costing. Now, the fixed manufacturing overhead is deferred. Deferred inventory is 5,000 units multiplied by 6, that will be 30,000. Okay, I repeat. Now, this one, this 80,000, okay, includes a fixed manufacturing overhead equivalent to 5,000 units times 6, which is 30,000. Okay, let's move to variable costing. Okay. Now for variable costing, just like in absorption costing, you will have the same amount for your sales. But if you remember the previous slide, in the previous slide, the product cost per unit is just 10 because it excludes the 6 pesos fixed manufacturing overhead. So the cost of goods manufactured is 25,000 times 10. It is not 16. And that is 250,000. Now, how much is your ending inventory? That's 5,000 times 10. That is 50,000. So you have the variable cost of goods sold, which is 200,000, plus the variable selling and administrative expense. You sold for 20,000. The rate is 3, so you have 60. So total is 260,000. Now, 600 minus 260, you have a contribution margin of 340. And then we deduct the fixed expenses consisting of the fixed manufacturing overhead. The one given is 150,000, followed by the fixed selling and administrative expense of 100,000. So total here is 250, deduct from 340. Then you have the net operating income. Question, what's the difference between the net operating income under absorption, that is 120,000, under variable, it is 90,000. What is the difference? The difference is 30,000. And the difference is in the fixed manufacturing overhead that is deferred in inventory. That is included in the 80,000. I repeat, the difference of 30,000 is equivalent to the amount of fixed manufacturing overhead that is there in the ending inventory. And it is 5,000 times 6, it is 30,000. Okay? So, learning objective number 3, we reconcile. Or you know already how to reconcile. One has 120, another has 90. So the difference is 30. Okay, so here we have the cost of goods sold, the ending inventory, the period expense, and the total. Okay, under the absorption costing, variable manufacturing costs are 200,000 plus the fixed manufacturing cost of 120,000. So you have here 320,000. Okay. Now the ending inventory, you have here what? 50,000 and 30,000. So you have a total of 80,000. For the period expense, this is 0. So the total here is 200 plus 50. That's 250,000. Fixed manufacturing cost is 120 plus 30. That's 150,000, or a total of 400,000. Under the variable costing, okay, you have a variable manufacturing cost of 200,000. And of course, there is no fixed manufacturing cost here. And your ending inventory is just 50,000. Okay, now where is the 150,000 fixed manufacturing cost? It is part of your period expense. Okay, under variable costing. And so here you have a total of 250, 150, or a total of 400. So they have the same total of 400,000 each. Pero iba ang pinuntahan nila dun sa income statement. And where is the difference? The difference is in the ending inventory. How do you reconcile? So variable costing net operating income is 90,000. But absorption costing net operating income is 120. So what's the difference? 30,000. How do you account for the 30,000? It is the fixed manufacturing overhead cost deferred in inventory. What is it? Units of 5,000 multiplied by the fixed manufacturing overhead per unit of 6. So 5,000 times 6, that's 30,000. Okay? In year 2, okay, in year 2, the number of units produced, 25,000, and then you sold 30,000. Is it true that you have 5,000 in the beginning inventory? Okay. So how do you account now? 5,000 beginning inventory, additional production of 25,000, that is a total of 30,000. Less the units sold of 30, so we will have no ending inventory. The selling price is 30. The variable cost of materials, labor, and variable manufacturing overhead, that's 10. The variable selling is 3. And then you have the same amount for fixed manufacturing overhead and fixed selling and administrative expenses. Let's compute. What's the unit product cost under absorption? So it includes everything. So 10 plus 6 is 16. What's the unit product cost under variable costing? It excludes the fixed manufacturing overhead of 6. So it is just 10. There's no additional 6. And since the variable cost per unit, total fixed cost, and the number of units produced remained unchanged, the unit cost computations also remain unchanged. So here now is the absorption costing income statement. How many units are you going to sell? 30,000 times 30, that is 900,000. Next, the beginning inventory is 5,000 times 16. The cost of goods manufactured, you manufactured 25,000 times 16. So you have here a total of 480,000. And there is 0 ending inventory. Why? Because you have 5,000 in the beginning. You produced 25, so that's 30. And you sold 30. So this is 0. So 480,000 less 0, this is 480,000. The gross margin is 420,000. Now you go to your selling and administrative. How many were sold? 30,000. The variable rate is 3. 30,000 times 3, that's 90,000. And then you have the fixed selling and administrative, which is 100,000. Here you have a total of 90 plus 100, that's 190,000. So the net operating income is 420 minus 190. You have 230,000. The fixed manufacturing overhead released from inventory is 5,000 units times 6, that is 30,000. Where was it released? In the beginning inventory. Next, under variable costing, of course, you have the same amount for sales. This time, the unit product cost is 10, not 16. So 5,000 times 10, that's 50,000. 25,000 times 10, that's 250,000. You add, there's no ending inventory, so this is still 300,000. Add the variable selling and administrative of 90, then this is now 390,000. The contribution margin is 900 minus 390, this is 510,000. And then you include the fixed overhead, the fixed selling and administrative. This is 250. The net operating income is 510 minus 250. This is 260,000. Is there a difference? Under absorption, your net income is 230. Under variable, your net income is 260,000. How much is the difference? The difference is 30,000. Where is the difference? It is in the beginning inventory, which is 30,000. Okay, that's a comparison of the two approach. Okay, so this is another comparison. Let's have the key insights. Relationship between production and sales. Okay, in one, when units produced are equal to units sold, then the effect on inventories is no change in inventories. And the relationship between variable and absorption income, absorption net income is the same with variable net income. Okay. Let's have another scenario. Units produced is greater than units sold. Okay, what happens? Of course, inventories will increase. Like in our first example, it produced, ilan ba yung pinroduce niya? 25,000, nagbenta siya ng 20,000. So may natitirang 5,000. And in terms of net income, absorption net income will be greater than variable net income. Another scenario is when units produced is less than units sold. Like in the last example, you just produced 25,000 but you sold 30,000. Inventories will decrease. And absorption net income will be less than variable net income. Okay? Now, let us understand the advantages and disadvantages of both variable and absorption costing. The impact on the manager. Opponents of absorption costing argue that shifting fixed manufacturing overhead costs between periods can lead to faulty decisions. Kasi di ba yung overhead na fixed, nandun pa siya sa ending inventory eh. So, papasok pa siya sa succeeding period. Now, this tells us that the opponents of absorption costing, they argue that shifting fixed manufacturing overhead costs between periods can lead to faulty decisions. These opponents argue that variable costing income statements are easier to understand because the net operating income is only affected by changes in unit sales. This produces net operating income figures that are consistent with managers' expectations. So those are the arguments. Next, absorption costing does not dovetail with CVP analysis, of course. No, kasi yung CVP analysis, yung variable costing ang sinusunod niya. Nor does it support decision making. It treats fixed manufacturing overhead as a variable cost. It assigns per unit fixed manufacturing overhead cost to production. Now, treating fixed manufacturing overhead as a variable cost can lead to faulty pricing decisions and faulty keep or drop decisions. Assigning per unit fixed manufacturing overhead cost to production can potentially produce positive net operating income even when the number of units sold is less than the break-even point. Okay, so these are some of our arguments again. No, okay. Now, in terms of external reporting and income taxes, as we mentioned, which one is for external reporting? It is the absorption costing. Now, what are the advantages of using variable costing? These are the advantages. That's why we use it for internal use. Management finds it more useful, consistent with CVP analysis. The net operating income is closer to net cash flow, consistent with standard cost and flexible budgeting, easier to estimate profitability of products and segments. Profit is not affected by changes in inventories, and the impact of fixed costs on profits is emphasized. Why? Because in this variable costing, all fixed costs are presented as part of the expenses. They do not enter the inventory account. Okay, another one, variable versus absorption costing. So, si absorption costing, sinasabi niya, fixed manufacturing cost must be assigned to products to properly match revenues and costs. Si variable costing naman, sinasabi niya, fixed manufacturing costs are capacity costs and will be incurred even if nothing is produced. Diba? Kasi si variable costing, tinitreat na niya kaagad to eh. Diba? Buo, wala siyang ina-allocate. So sinasabi niya, they will be incurred even if nothing is produced. Now, the absorption costing naman, yung mga tagapagtanggol niya, they have a different argument. Okay? Now, how is this related to the theory of constraints? The companies involved in TOC use a form of variable costing. However, one difference of the TOC approach is that it treats direct labor as a fixed cost for 3 reasons. Many companies have a commitment to guarantee workers a minimum number of paid hours. This is true. Direct labor is usually not the constraint, and TOC emphasizes the role direct laborers play in driving continuous improvement. Since layoffs often devastate morale, managers involved in TOC are extremely reluctant to lay off employees. Now, what's the impact of lean production? When companies use lean production, when do you say that there is lean production? No, when production tends to equal sales. Wala silang masyadong difference. Like you produce 25,000, you sell 25,000. So there are lesser inventories, no, in the end. So the difference between variable and absorption income tends to disappear. Di ba sabi natin kanina, no? When units produced equals to units sold, then there is no difference between absorption and variable. So yung difference nawawala kapag nandun ka sa lean production. Okay? Next, let's go to learning objective number 5. Compute the predetermined overhead rates and explain why estimated overhead costs rather than actual overhead costs are being used in the costing process. Why is it so? Bakit kaya? In actual, bakit kaya useful yung estimated overhead cost ang ginagamit natin? Anybody? Why not the actual overhead costs? Why do we have to estimate overhead? Well, one reason is information like the actual overhead costs are not readily available at the end of the month. One example is if you are incurring electricity expense, the electricity bill does not come at the end of the month. Normally, it comes after the end of the month. So manufacturing overhead is applied to products or jobs that are in process. An allocation base such as direct labor hours, direct labor dollars, or machine hours is used to assign manufacturing overhead to individual products or jobs. Ine-estimate muna natin yung overhead. Okay? But of course, we account also later on the actual overhead. In fact, we compare the estimated overhead versus the actual overhead. And then we determine the difference. Now, why do we use an allocation base? Sinasabi natin, bakit kailangan estimated overhead muna? Ba't hindi siya actual overhead? Number one reason, di ba sabi natin, normally they are what? Indirect in nature. So it is difficult or impossible to trace overhead costs to particular products or jobs. Number two, manufacturing overhead consists of many different items ranging from the grease used in machines to production managers' salary. And then many types of manufacturing overhead costs are fixed even though output fluctuates during the period. Okay, let's continue with manufacturing overhead application. The predetermined overhead rate is used to apply overhead to products or jobs. It's determined before the period begins. So even before the period begins, you already have the POHR, the predetermined overhead rate. How is it computed? The estimated total manufacturing overhead cost for the coming period over the estimated total units in the allocation base for the coming period. So meron ka ng overhead rate. You estimate the total manufacturing overhead cost for the coming period. And then you estimate also the total units in the allocation base for the coming period. Ideally, the allocation base is the cost driver that causes the overhead. Okay, the need for a predetermined overhead rate. Using a predetermined rate makes it possible to estimate the total product or job cost sooner. Ito yung sinasabi ko kanina, no? Like, if you talk of electricity bill, it doesn't come at the end of the period. So actual overhead for the period is not known until the end of the period. Or sometimes, even after the end of the period, it is still not known. Now, the predetermined overhead rates are calculated using these three steps. One, estimate the level of production for the period. Number 2, estimate the total amount of the allocation base for the period, and then estimate the total manufacturing overhead cost. What's the formula? 3 divided by 2. You estimate the manufacturing overhead costs, and then you have the allocation base. What could be examples of those allocation base? Like, for example, direct labor hours, or direct labor in dollars or pesos. So you divide, no, 3 divided by 2, then you have your POHR, the predetermined overhead rate. And then how do you apply? Now, first you have the estimate, the predetermined overhead rate. Now, how do you apply? Now, when you have the rate, you multiply it with the actual activity. Let's say, for example, the actual direct labor hours multiplied by the POHR. Then you have the overhead applied. Let's have an example. No? In this example, the denominator or the allocation base would be the direct labor hours. Now, if your estimated manufacturing overhead is 150, then the rate is 150,000 divided by 50,000. That will be $3 per direct labor hour. Now, titignan mo, ilang direct labor hours ba ang actually meron? So, multiply that by 3. That will be the applied overhead. Okay, let's read this. For each direct labor hour worked on a particular product, $3 of factory overhead will be applied. So for product valuation, it must be valued by unit. In this case, assume each unit requires 2 direct labor hours. Hence, each unit of the product absorbs 2 times 3. If you're saying that the predetermined overhead rate is 3, and you're saying also that each product requires 2 direct labor hours. Therefore, 2 times 3 is 6. So in order to match back with Harvey's example, we further assume that variable manufacturing overhead is equal to 0. So the predetermined overhead rate represents only the fixed manufacturing overhead cost as shown in slides 14 and 19. Okay, we understand the implications of basing the predetermined overhead rate on activity at capacity rather than on estimated activity for the period. Or what's this one? It considers the capacity, no, of the department. Okay. Now, calculating predetermined overhead rates using an estimated or budgeted amount of the allocation base has been criticized because basing the predetermined overhead rate upon the budgeted activity results in product costs that fluctuate. Okay, so halimbawa, in-estimate mo lang yung direct labor hours, no? So pwedeng mag-fluctuate din yung direct labor hours mo. O number 2, calculating predetermined rates based upon budgeted activity charges products for costs that they do not use. So how do we solve that problem? No? Okay. So here we have the capacity-based overhead rates. The criticisms can be overcome by using the estimated total units in the allocation base at capacity. Ito yung what the department is capable, no, of giving. Let's look at the difference. Example. The equipment is leased for 100,000 per year. That's your cost. Running at full capacity, 50,000 units may be produced. Okay, so that's 100,000 divided by 50,000. You will have $2. No? O this one naman, the company estimates that 40,000 units will be produced. If I will use 40,000, that's 100,000 divided by 40,000. That will be 250. So they will give you different rate. No? If I use 50,000, this is the full capacity. I'll use this as my denominator. I will get 2. That's 100 divided by 50. But if I will use my estimate of production, which is 40, that will be 100 divided by 40. That will be again 2.5. So what's the difference? 2 versus 2.5. There is a difference of 0.5. Okay? So ito yon, no? Ito yung traditional method. O, let's use the full capacity units. Ayan, this is 2. Is there a difference? Yes, there's a difference of 50. Okay, so let us have a quick check. Barossa Winery in Barossa Valley. Oh, there's Barossa pala in other countries. Ayan. This is an automatic corking machine for $100,000 per year. At full capacity, it can cork 50,000 cases of wine per year. The estimate is 40,000. Now, what is the predetermined overhead rate based on the estimated number? What will you use kung estimated? 40,000. What's your answer? What's the rate per case? Is that 100,000 divided by 40,000? That will give you 250 per case. Let's have another quick check. What if you determine the rate based on capacity? Based on capacity, it's 100,000 divided by 50,000. What's the rate? 100,000 divided by 50,000. You will get 100,000 divided by 50,000. The answer is 2 per case. Another quick check. When capacity is used in the denominator of the predetermined rate, what happens to the predetermined overhead rate as estimated activity decreases? Kanina ano siya? 2 under capacity. Underestimated, ano siya? 250. No? Ano raw mangyayari kapag bumaba yung estimated? The predetermined overhead rate goes up when activity goes down. The predetermined overhead rate stays the same because it is not affected by changes in activity. And the predetermined overhead rate goes down when activity goes down. What's the answer? It stays the same, no? Because it is not affected by changes in activity. Kasi you are estimating it at estimated activity. Okay. Next, when estimated activity is used in the denominator of the predetermined rate, what happens? O ito, mayroon na bang change ito kapag ganyan? No, kasi ginagamit mo raw denominator is estimated activity. Now, what happens to the predetermined overhead rate as the estimated activity decreases? So, anong mangyayari sa overhead rate mo pag bumaba yung denominator mo? Sagot, A, B, C.
A.
Yan, A. The predetermined overhead rate goes up when activity goes down. Okay? So, let us prepare the income statement under the capacity. Okay, if we're using capacity, all right? So, let us say the actual volume, we have your 40,000 cases. The selling price is 40 per case. The variable production cost is 24 per case. The fixed manufacturing overhead is 100,000. The capacity is 50,000 cases. The predetermined overhead rate is 2 per case. The fixed selling and administrative expense is 500,000 per year. How do you compute for your revenue? The selling price is 40. Okay, you sold 40,000. That's 40,000 times 40. That's 1,600,000. Now, how do you compute for the cost of goods sold? Ayan. So, how do you compute for the cost of goods sold natin? Paano na-compute yung 1,040,000? Anybody?
Variable production cost $24 plus $2. Predetermined overhead rate is equals to $26 multiplied by actual volume, which is 40,000 cases.
And then you will get
1,040,000.
1,040,000. That's sino yun? Si Maria Carmela. Thank you. Okay. And your net nakuha niyo ba yung sinasabi ni Carmela? Okay. So, meron kang variable production cost na 24 plus yung predetermined overhead rate na 2. So, that's 26. Now, multiplied by the volume of 40,000. Okay, so you have the 1040,000. The net operating income here is 40,000. Okay, so next, let's have the traditional. No? Under the traditional, okay, this is 250, no, as differentiated from 2. No, so yung cost of goods sold niya, naka-base siya dito, no, sa 250. And this time, it's no 1060,000. Yun ba yung 24 plus 250 multiplied by 40,000? No, and you will have what? A gross margin of 540,000. The selling and admin expense is 500 and the net operating income is 40,000. Okay? Now, without this cost of idle capacity, no, they will be different in net operating income. Okay? Next. Now, we compute for the under-applied or over-applied overhead costs and prepare the journal entry to close the balance in manufacturing overhead to the appropriate accounts. No? So, never mind if you don't understand the journal entry, but nevertheless, let us present them. No? Okay. Now, how do you understand under or over applied? Di ba meron kang estimate? No, in-estimate mo siya. Let us say 100,000. You applied 100, You applied 100,000. No? Tapos yung actual mo, 120,000. Is there a difference? You over-applied 20,000. Okay? Now, tama ba? Ulit. If your applied is 100 and then actual mo is 120, actually you under-applied. Under-applied. Okay. Now, if your applied is 100 and then your actual is 80, therefore you over-applied. Okay? O you correct me kapag mali yung sinasabi ko. So the difference between the overhead cost applied to work in process and the actual overhead cost of a period is referred to as either under-applied or over-applied overhead. Yeah. Under-applied overhead exists when the amount of overhead applied to products during the period using the predetermined overhead rate is less than the total amount actually incurred. No, like yung sa example natin kanina. No, you applied, let us say, 100,000. Ang actual is 120,000. So you under-applied. Ito naman. Overhead applied exists when the amount of overhead is greater than the total amount of overhead actually incurred. Like you applied 100, pero you actually incurred 80,000 lang. So you over-applied. Let's have this one. Recall the Harvey example between slides 9 and 36. Let's rename the examples Harvey Fresh and assume actual overhead for the year was 120,000 instead of 150,000. The total direct labor hours incurred were 50,000. The rest remains the same. Now let's just try to remember them. Now let's go back to 9 and 36. Now, how much total overhead was applied to Harvey Fresh products during the year? Use the predetermined rate of $3 per direct labor hour. Let us see. Let's look at the computation. No? Okay. Now here, now the applied overhead is 3 times 50,000, and that is 150,000. Okay, if this is the applied overhead, 150,000. And this is what? The actual overhead. If we're comparing the two, 120 now versus 150,000, did we over or under apply? If we're comparing 120,
Over-applied.
Ayan, nag-over-apply ka. No? Okay. Harvey Fresh has a over-applied overhead for the year by 30,000. Ano daw ang dapat gawin, no?
Enter.
Oh, here. Yun ba yun? Ayan, okay. Tiger Limited, the actual manufacturing overhead cost of 1,210,000. and a predetermined overhead rate of 4 per machine hour. Tiger worked 290,000 machine hours during the period. Let's identify what is 4. 4 is the predetermined overhead rate. No? How do you apply? Kukunin mo yung actual machine hours work. Diba? So that's the applied, correct? So 4 times 290,000, that's the applied overhead. What's the actual? 1,210,000. Okay, what's the answer? Over or under? 50 or 60? Magkano?
50,000.
15,000 over
Is it letter
applied siya.
B? A ba or B?
A.
Guys, A
B
or B?
po.
B.
B.
So, tignan na lang natin
Under-applied po.
kung sinong tama sa inyo. Okay, and the answer is B. Ayan. Tignan natin ha. Okay. So overhead applied, that's 4 times 290,000, that's 1,160,000. Pero ang actual mo ay 1,210,000. So, nagkaroon ka ng under-applied overhead. Konting ano lang yun, no? Okay. Next. Now, how do you dispose of the difference? No? So, sinasabi dito, disposition of the difference. Number 1 approach, ito, pwede mo siyang allocate daw no? Sa work in process, sa finished goods, at saka sa cost of goods sold. So, kung meron kang did we say under-applied? Yes, na under-applied. So, dadagdagan mo ngayon si work in process, si cost of goods sold, at saka si finished goods. I-allocate mo sila based do sa ending balances no, of these 3. The easier approach is, isasara mo na lang siya sa cost of goods sold. So, kung under-applied siya, dadagdagan mo si cost of goods sold. Kung over-applied siya, babawasan mo si cost of goods sold. Okay? So, ito yung ano let me just read them, no? Ito yung, what are this? Ito yung mga T accounts. I don't know if accountants are still using T accounts, no? This is the T account. Ito yung parang general ledger na tinatawag natin, no? Kaya lang, since hindi naman tayo makapag-present ng general ledger dito, no? Nagko-consume siya ng too much space, kaya ginagamit nila yung T account, no? The T account has 2 sides. The left side, which is the debit portion, and then the right side, which is the credit portion. Anyway, no? So this is the harvest, this is the cost of goods sold account. Okay, this is the manufacturing overhead account. Okay. Paano nagkakaroon ng entries dito sa manufacturing overhead? No? Okay. The entry to apply overhead is to debit work in process, credit manufacturing overhead. So nandito siya sa credit, no? Yung overhead applied. Tapos as you incur actual overhead, the entry naman is to debit manufacturing overhead, credit cash or accounts payable. Okay. That is why in the end, no, you have to compare the two. So pwedeng may under, pwedeng over. Like in this case, no, there is what? Over-applied overhead. Kasi you applied 150, the actual is just 120. And this has what? A credit balance. No, 150 minus 120. The credit side is bigger. So there is a credit balance of 30,000. Diba sabi natin, kapag over-applied, bawasan mo yung cost of goods sold or bawasan mo yung tatlo, no? Yung cost of goods sold, work in process, at saka yung finished goods. Paano mo babawasan kung may sa credit side? E di debit mo. No? So the entry is to debit, no, manufacturing overhead. Magsi-zero na siya. So i-credit mo ngayon si cost of goods sold o kaya yung tatlo. O never mind if you don't understand that. No? Yan. So ito yon. Since over-applied siya, i-debit mo raw si manufacturing overhead, credit mo si cost of goods sold. Right? Okay, if the adjustment is made to the cost of goods sold, this is how it will appear, no? So 400,000 less over-applied, then you have the goods available for sale. Okay? Next. Let's have this one. Iba yung lumalabas. This is allocating under or over-applied overhead between accounts. Okay. In the previous slide, no, we disposed the over-applied or the under-applied by increasing or deducting your cost of goods sold. Paano daw kapag isasara mo dun sa tatlo? This is another approach, no, work in process, finished goods, and cost of goods sold. And then you do the allocation. Now, how do you allocate? Like 30 over 150 and 120 over 150. Ayan. So, ito yon. So, the allocation is 30 over 150 or 20% or 120 over 150 or 80%. Let's allocate 30,000. 20% of 30,000 is 6,000. 80% of 30,000 is 24,000. So, this is the over-applied overhead. So, anong gagawin mo? Babawasan mo raw yung finished goods ng 6,000. Babawasan mo yung cost of goods sold ng 24,000. And this is the entry. How to bawas? Credit work in process inventory, credit finished goods inventory, credit cost of goods. Ayan, for the non-accountants, never mind. So this is how it appears, no, in the income statement. Let's have another one. No, quick check. Revisit the earlier Tiger Limited exercise on slide 56. Before any manufacturing fixed overhead or over or under applied adjustment. These are the figures, no, 20,000, 30,000, and 50,000. How much should Tiger's over or under applied manufacturing fixed overhead be adjusted to finished goods if the proportional allocation method is used? So hindi natin alam kung magkano, no, if it is 15,000 or 30,000. Let's not go back to slide number 56. What we will do is you have to allocate kung ano man yung difference nun. Diba? Guys, what will be your fraction for finished goods? Kasi tinatanong niya dito finished goods. Eh. Ano ang fraction mo to allocate?
30,000 over 100,000.
Yes. Zarina, what's your fraction?
60%.
Ako po yan.
Ano nasasalta? Si Zarina ba? Sorry, si Jamaica.
30,000 over 100,000 po.
Correct. 30,000 over 100,000. O, ito siya, ha? Multiplied by 50,000. So, will you get what? 15,000, Jamaica. So, ito yung allocation.
Yes.
O, another one. Okay. Magkano raw sa cost of goods sold? Kung cost of goods sold, anong fraction mo? 50 over
100.
over 100. Okay. And magkano yung ina-allocate natin? If that is 50,000,
25.
that's 50% or 25,000. Okay, now we go to learning objective number 8. Now, explain the potential problems of using absorption costing. This is the one for external reporting. In absorption costing, lahat ng elements of cost, in direct materials, direct labor, variable and fixed manufacturing overhead, pumapasok sila lahat do sa product cost. So it says here, if we continue with the Harvey Press example, I don't remember, no, the slides 54 to 58 and 64. Oh, let's just read this. Assume the company had the same sales, revenue, and cost structure, but produced 35,000 units. Okay, so nag-increase yung kanyang ending inventory. Okay, so pareho siya ng sales, beginning inventory, parehong wala, cost of goods manufactured, no? Okay, so this is 400,000. This is 560,000. Then there's the over-applied adjustment here, the goods available for sale, and then the ending inventory. Ayan. So sinasabi niya dito, no, that there is the possibility of increasing the profit by 60,000 without extra sales and revenue. I think this was discussed in the previous slides, no, using absorption costing. Why? Kasi yung sa difference kasi sa ending inventory nandun. Di ba? So titignan mo to, pareho lang yung kanyang sales. Pero hindi siya pareho ng pinroduce. No? Kasi dito, nagkaroon pa siya ng ending inventory. At makikita mo, mayroon palang effect. No? Saan? Sa net operating income. Eh paano? Yung fixed overhead na nandun sa ending inventory, hindi pa siya pumasok dito. No? Nandun pa siya sa ending inventory. Okay? Kailan siya papasok? Mare-release pa lang siya the following period. Overhead, over-applied adjustments required. Of course, we know that already. No? Kapag over or under, alam natin yung plus or minus, cost of goods sold or sa tatlong accounts. Work in process, finished goods, and cost of goods sold. Ayan. Ito rin yung sa value ng ending inventory. You guys, you know already the difference in ending inventory. What's the difference between the two? It's the ending inventory portion referring to what? The fixed manufacturing
Manufacturing overhead.
What about here? No? Using the variable costing. Kasi kanina, nagkaroon ng difference in net income. Di ba? If nagkaroon ng difference dun sa units produced, 25,000 and 35,000. O sinasabi dito ngayon, what if you are using variable costing? So sinasabi dito, whether you produce 25,000 or 35,000, okay? Kasi yung fixed manufacturing overhead, pareho lang ang treatment. Ito, 120,000 tsaka 120,000. Considered as period cost kasi siya. Diba? Walang natira sa inventory. Lahat kinuha for the period. Lahat in-expense for the period. And according to this, if you are using the variable costing, whether you produce 25,000 or you produce 35,000, net operating income will be the same. That's 120,000. Diba? As compared to sa kanina, if you're using absorption, kahit hindi gumagalaw yung sales, the mere difference no in your units produced, nagkakaroon siya ng difference to sa net operating income. So use of variable costing can avoid the inflation of profit by producing more inventories. So we know this already kanina, no? If overhead is applied, is under-applied or over-applied. If it is under-applied, edi idagdag mo sa cost of goods sold. Or idagdag mo doon sa tatlong accounts. That's alternative number 2. Pero ang mas madaling gawin yung number 1, alternative. If it is over-applied, edi ibawas mo. Ito rin, ibawas mo rin dito. Sabi niya, this is the more accurate but more complex to compute. Quick check. What effect will the over-applied overhead have on Harvest net operating income? Ano raw ang effect kapag na-over-apply mo yung overhead? Assuming hindi mo siya kinorek, no? Hindi ka nagkaroon ng adjustment. What's the answer? Oh, well, alam natin, no? If you overstate your ending inventory, you overstate your net income. If you understate your ending inventory, you understate your net income. What about the cost of goods sold? Now, if you overstate your cost of goods sold, what happens to your net income? You understate your net income. Anong sagot dyan? The net operating income will increase. Diba? Can you explain this? You can explain this. Ano to?
Yes
Ito ba yung
po.
effect o yung ano? Ito yung... You can explain this.
I think kasi pag over-applied siya, sir, mapabawasan yung cost of goods sold natin. So pag mabawasan yung cost of goods sold is mag-increase yung income natin.
Tama na. Multiple predetermined overhead rates. To this point, we have assumed that there is a single predetermined overhead rate called a plant-wide overhead rate. Yeah. Large companies, they often use multiple predetermined overhead rates. May be more complex, but may be more accurate because it reflects differences across departments. Ayan. E tayo naman when we are... Okay. And that is the end of the chapter. So basically,